Good morning, everyone, or good afternoon, depending on where you are in the world. My name is Daniela Haythorn. I am a senior market analyst at Capital.com, and usually I'm joined by my colleague Kyle, who is in Australia, but he's unable to join this week. So I'm actually joined by Monty, who is based in the UAE. Monty, good morning, good afternoon to you.
Yeah, good
Um,
afternoon.
So we are going to be taking you, of course, as usual, through Market Mondays. For those of you who join us weekly, we'll take you through what's been happening in the market, specifically focusing on a few risk events that we saw last week, and of course, a few things to point out heading into this week. But before we get into it, as always, we've got to take you through the risk warning. Just be aware, of course, that the products that we offer at Capital.com, so CFDs primarily, but for those of you in the UK, also spread bets, are complex instruments. They do carry a high level of risk. So be aware of this, and please make sure that when you are trading our products, they are suitable for you and your own personal circumstances. And also a disclaimer that all of the information you're going to hear in this webinar is general information only, general market commentary. It does not take into account anyone's personal circumstances. So please do not take this as trading or investment advice. So once we've gotten that out of the way, a few things we were looking at this week. It's not the busiest week on the calendar. In fact, we've actually just come off one of probably the busiest weeks of the year, definitely of the quarter. And of course, we've seen a little bit of reaction in markets, so we'll go quickly through that. But we saw the FOMC meeting on Wednesday, and we actually saw Powell taking a little bit of steam out of the market, tempering some of the expectations for aggressive rate cuts into 2026. So we saw a little bit of pullback in markets on the back of that. We also had one of the busiest weeks in the earnings season, the Q3 earnings season, with some of the Magnificent Seven companies reporting, like Meta, like Amazon, and Apple. We saw some mixed results from there, so also some volatility in the market. Looking ahead to this week, as I said, not the busiest week on the calendar. We do have the BOE, so the Bank of England, and the RBA in Australia. They will be meeting this week. Not much is expected from both of them. We'll have a quick quick overview into what's expected. We're still in the data blackout with the government shutdown in the US, so we won't have any NFP or any official employment data from the US. So we'll have to rely on the ADP data, the private payrolls data on Wednesday. And of course, the PMIs, the sentiment readings will also be released this week. Now, before we get into it, Monty, as I was saying earlier, we saw the FOMC meeting last week kind of taking away some of that expectation that markets are priced in going into 2026, heavily leaning towards more rate cuts from there. I think it's a delicate act of balancing those expectations, and the Federal Reserve clearly wanting to take a little bit of steam out of there without completely pushing down on the positive sentiment we have. They just, I think, wanted to cool some of those expectations. What are your views on what we saw last week on the back of that?
Yeah, and I like the way a lot of the members came out afterwards, or some of the members have come out afterwards when they were speaking. I mean, you had, what was it? Was it Logan Hammock that came out, and then Logan said they were wrong to cut rates last week. They're skeptical that there's going to be a rate cut in December being the right move. Hammock said that they wouldn't have agreed, had been able to vote, wouldn't have agreed to a rate cut. Schmidt clarified his opposition as to why is it that he wasn't in favor of a rate cut, because that wasn't all, like you mentioned, sort of you could say that was sort of a hawkish cut, right? I mean, they all but one voted for it, and then you had Powell come out and sort of give a bit of a hawkish twist to it as well. And then even Bostic, I think he was the one that said that he only eventually was in favor. I mean, the way in which it's like sort of like saying, I didn't want to go to the rate cut party, but peer pressure kind of forced me into it. I might have done something I might have regret. Don't hold me to it. It's the attitude in which they were doing it, is that they're sort of backing off of it quite a bit. And I think that also obviously is going to impact and is going to sort of tell market participants that, hey, as much as markets love rate cuts, the fact is we may not get as many of them. And if you look at if you look at the way in which markets are pricing, the way in which they're reacting, it's not really so much in favor of fully pricing in rate cuts like they were before the event.
Yeah, I agree. I think, as we were saying, it was more of a balancing act of trying to the Fed has a dual mandate, stable employment and inflation. And the last few months with the labor markets showing signs of weakness, obviously up until September, because we haven't had any recent data. But that was kind of what was powering this view that the Federal Reserve was going to continue cutting rates, even as inflation was staying above target, which is something the Fed was able to tolerate given the weakening labor market. So a lot of the pricing in that we'd seen heading into 2026 was based on that weakening labor market. However, I feel like this meeting kind of recalibrated that dual mandate a little bit more, and it kind of, gave the view that inflation is still holding near 3% and it's expected to hold closer to 3 than 2% heading into next year. So with inflation still being a little bit stickier than hoped, it's really a case of trying to balance those expectations, because you don't want the Fed cutting heavily into 2026 and then halfway through having to backtrack and potentially hike because they got a little bit too ahead of themselves. So I think, the measured tone kind of set off a little bit of an immediate reaction in markets. But I think if you look at deep down into, it's more a case of a balancing act. And I don't think it completely invalidates the positioning that we'd seen heading into this meeting. It just softens a little bit of the aggressive schedule that was priced in. So if we're looking at the Fed Watch tool on the screen, you can see here, this is the December meeting. So the expectations now at around 70% priced in that we see another rate cut from the Federal Reserve at the end of the year. If we're looking at what it was a week ago, so on the 27th of October, you can see here the massive change. So it went from about 95% priced in that we were going to see a cut in December to 69, 70%. So clearly that was on the back of that meeting, and it just kind of rebalanced and reset those expectations that were leaning so heavily towards easing and towards a Fed rate that was closer to 3% heading into June 2026 than where it is now. So it's interesting to see how markets have evolved on the back of this. Monty, before we go into the actual charts, I quickly just want to pull up the FactSet earnings insight. It's something that Kyle and I use quite often in these meetings to highlight to our viewers kind of what's been going on in the earnings season. Because we did have one of the busiest weeks last week, specifically with those tech companies. And we often look at how the blended earnings growth estimates have changed. Now, about 64% of the S&P 500 companies have reported as of Friday last week. 83% of them actually reported positive earnings per share surprise. Again, a very strong quarter. The blended earnings has now increased to 10.7%. So we're now at that double digit for what's expected to be the earnings growth for the quarter, coming back from 7.9% at the start of the earnings season. So more than 2 percentage points here have risen throughout the earnings season. So clearly a positive quarter so far. However, we did see some mixed results from the tech sector last week. Meta being the standout there. We actually saw a significant drop on the share price. I think it's down to a 4-month low after disappointing not so much on the top level results, but actually a tax hit that they had and some increase in the cost structure that they've reported in the quarter. So even though the data wasn't dire, I still think, and we've said this before, expectations are so high for these companies, not only to deliver good results, but to deliver outstanding results and to beat their previous quarter by a significant amount, that it really has left an area of risk and downfall risk if these earnings disappoint. What are your views on this?
Yeah, I know with what is it with high valuations come high expectations, especially with stock market has gone up so much, especially when it comes to tech and AI. So investors don't just they want to see a beat, they want to see a clear beat across all key metrics, and then they also want to make sure that when it comes on the AI front, that the money that's going in, they're actually getting a decent return. And any sort of hiccup, any sort of bump, any sort of speed bump is obviously seen as a negative for some of those companies. Now the thing is, on the hardware front, we know that this was I would say last week was a pretty big win for NVIDIA in all, just because of the fact that they're all going to increase their capital expenditures. I know it's not all going to be on NVIDIA, but the fact is if it's still the AI engine and the majority of the purchases are going through them, I still think it's been a good thing for them. And what's good for NVIDIA at times, just because at times it feels like it's not the S&P 500, it's more like S&P NVIDIA, just because of the way the market moves at time with the AI trade. I feel like it's been that as long as there's enough demand, at least on the hardware front for NVIDIA and co, that's seen as a relative plus for the market. And then of course comes the next part, I think, which investors are still looking into and still want a good response, is whether or not it's really going to justify the amount of money that not only the amount of money that's gone in so far, but the amount of money that's going to go in next year. I mean, they all talked about increasing their capital expenditures, and next year is going to be even higher. Some of them were mentioning about how next year is going to be higher. So I still think that for investors, if you look at the weekly investor flows, they haven't been getting out of tech. They're still they wanted to get in on the AI trade early. They got in early. They're still holding on. I don't think what we saw last year is a catalyst that's going to push them away and say, hey, I want to get out of the AI trade. I haven't seen it yet. I think it's going to take a whole lot more than that before they actually get shaken out of the AI trade. And then you got to wonder, well, where else can I go, in exchange. If I'm not going to be in the AI trade, where else am I going to put that money, or where am I going to put it to work? I know that if you look at like the earnings for Berkshire Hathaway, the scary part is when they raise their cash hoard to, what was it, almost 300 and was it 380 $381.6 billion, a record for them. You got to wonder, he's either really, really, really right or really, really, really wrong. There's no middle ground here when you have that much cash. It's a mountain of cash that he's going to leave to his successor. But it always does make you wonder that they've missed out on this big run, and they're still holding more cash, still net, net sellers of equities in the past quarter, no share buybacks. It's a very, very risk-off approach that he's taking, opposite to what we've seen in the market and opposite to what we've seen investors in general do when it comes to the stock market.
Yeah, I think that's a good point. I think the tech sector, specifically the MAG7, continues to be the clear dominant and the clear driver in the market. I don't think that's anything that anyone's going to start questioning anytime soon. I guess it just goes back to the fact that, markets are once again trying to see whether these companies are actually seeing a return on their artificial intelligence investment, which has been what's been powering these earnings seasons for the last year or so. And also it kind of raises once again those questions as to whether the fundamental outlook can justify the current valuations. I think if you're looking at the earnings growth, clearly right now we are in the midst of it, and I think it is justified. And one of the questions we get a lot is whether this is a bubble, whether it's an AI bubble. And again, you just have to look at the price of these shares, but also the returns that these shares are getting. If you're looking at the share growth, it's backed pretty closely by earnings growth as well. So clearly, even though valuations may be slightly overstretched, the market has become expensive, from a fundamental perspective, they seem to be backed by the earnings growth. And I think any sort of jitters that you get in these earnings reports, clearly Meta was an example of this. Any sort of doubt that these returns are justified, that's when you see that significant pullback in the market. And we'll pull up the chart in just a second. But again, it goes back to investors really want to be sure that the price that these companies are trading at is justified by fundamentals. And any question whether that is not happening, I think that's clearly when you see that reaction in the market. So it really speaks towards that. Let's share some charts, and we can maybe start with these big companies. You can see here we've got Amazon, we've got Apple, we've got NVIDIA. Of course, we can't not mention NVIDIA being the first company in history to hit the $5 trillion market cap. That in itself is an impressive feat. We still have to wait a few weeks to see NVIDIA earnings, but the expectations hitting into that is outstanding. I mean, you can just see how strong the rally has been in the last few days. We have pulled back a little bit since hitting that 5 trillion mark. I think that's quite common and quite expected, given the amount of hype that there is around such a significant figure like this. But nonetheless, the momentum clearly remains to the upside. We can see here in Meta, you can see that reaction to that earnings report. As I said, it wasn't an awful earnings report. The revenues were still good. It was just a case of they undershot investor expectations. You can see how heavily punished the stock was here, hitting that 4-month low. Elsewhere, you can see Apple seeing some good momentum as well, but again, a little bit of indecision on the back of that earnings. Same with Amazon. We saw that strong open on the back of their earnings. Again, investors now questioning where to go next. So I think there's clearly significant appetite in these tech stocks in the MAG7. It's just a case of whether these fundamentals are going to continue backing the long-term potential that these stocks have. Monty, let's take a look maybe at some of the indices. We've got like the S&P 500, the NASDAQ. We've seen, as we said at the beginning, that momentum has slightly slowed heading into this week because of that Fed I wouldn't say disappointment, that they still cut rates as expected. It's more the view towards the future. Powell essentially saying that a cut in December is not guaranteed. We've seen how the market pricing has shifted. We're seeing here that that pullback that we saw in the S&P 500. We have to remember that most of these stock indices in the US are pushing new all-time highs pretty much every week. So clearly there's going to be a little bit of resistance in the technical side of this. What are your views on the US indices this week?
Yeah, and I would say also just want to add, like you mentioned, when it comes to the technicals, I still think that overall, when it comes to the key equity indices that we're tracking, especially for the U.S., the large caps, put aside the Russell 2000 for a second, but you look at these large cap equity indices, a lot of them are working within, I want to say, just they've gotten disturbed bull trend channels, just because we had, like, you had the announcement from with regards to the U.S. China, but when it first hit the wires, and you had that big pullback, and then it sort of recovers, and we've been in this phase where, I'm not saying buy the dip is the best strategy, but we've been in this phase where every single time some negative catalyst or something enters the market, you might see a volatile pullback, and then it sort of waits a little bit, and then it claws its way back, and it claws back that lost territory, and it makes a fresh record high. So from a technical standpoint, if you were to classify or give it an overview, for example, you're still in a bull trend or bull average overview. I don't think it doesn't mean that, past performance not an indicator of future results. Doesn't mean that it's going to stay bullish, but it does mean that at the very least, that given we're still within this channel, it's still relatively bullish. I think that on the flows front, it's still relatively bullish. And when it comes to clients on our end, by the way, client sentiment, majority buy when it comes to the S&P, the Dow, the Russell. And when it comes to the NASDAQ, shifting, they briefly went majority short when you had that big move up. Some of the longs got out, some shorts initiated. And then when it pulled back, you saw some of the longs get back in, and you've seen them rebalance a little bit back towards majority buy. So in all, it's still a majority buy sentiment. It's still a bullish technicals. And I think they're just waiting for a significant catalyst, which I don't think is going to be something technical. I think it's going to have to be something a bit more fundamental. I mean, you mentioned that we've got NVIDIA's earnings in a few weeks. They like to be fashionably late. That's just your style. Unlike me, they're fashionably late all the time. But we do have a proxy for them this week, if I'm not mistaken, both AMD's this week, and then we have the one who wants to enter the AI race, Qualcomm. They're also going to be, if I'm not mistaken, they're also releasing their figures this week. So, a couple proxies just to see how things are going on the AI front.
Yeah, we do have AMD this week, which is likely going to be one of the key earnings as we kind of get towards the latter end of this earnings season. It kind of starts to quiet down, but AMD will be a key contender. I mean, with NVIDIA, they are the backbone, they are the heart of the AI revolution, the AI infrastructure. I mean, from ChatGPT to Gemini, all of these large language models, they are running, so they are relying on NVIDIA chips. So the outlook is outstanding. I mean, there are questions as to the sustainability of the rally. I think one of the key concerns, maybe the risk profiles heading into the next few years, is the fact that markets assume that NVIDIA is going to have outstanding growth for quarters to come. That in itself sets the stage up for failure, even if it's minuscule. And I think these expectations are so high and so grounded on the fact that NVIDIA is the powerhouse of AI, that any changes to regulation, whether it's between China and the US, any changes in terms of new competitors coming in, any slowdown in AI spending, that can really challenge the status quo and challenge the current valuation of this company. So there are some risks ahead, but considering even considering these risks, I think, we're very much at the beginning of the AI revolution, of the AI journey. And considering NVIDIA's placement in the market, I just think that it has outstanding potential in the future. Of course, we may see some pullbacks along the way, some areas of overstretch and overheating market. But we're looking at the fundamentals, even though there are some risks ahead. I think it is so well positioned to be, the market leader for a while to come. So clearly, that is going to be a key power in the market, in the US stock market, if all of these things kind of fall in line and this momentum continues. Now, we can look elsewhere because the dollar has actually been quite interesting this week as well. Let's pull up the dollar index chart. It has once again seen some strong recovery. We talked about in the past kind of this double bottom pattern, which was signaling the move higher. We're now looking to break previous resistance here just below that 100 mark, around 99.70, 99.80. This is where we saw the highs back in August, trying to build up towards breaking this area here, seeing some resistance along the way. But last week was clearly a positive week for the US dollar. I think key drivers behind that, we've seen maybe perhaps a little bit of a return to normality. US yields are higher than most other countries, which of course is a driver for the US dollar, with the Fed being a bit more hawkish than expected. Again, another driver from the dollar. And the I guess to some extent resolving the trade dispute between the US and China, even though we're still to see some concise details come out. That, of course, once again, maybe pulled back on that sell America trade that had been weighing on the dollar for quite a while. So we saw a significant week for the dollar index. And of course, that means that the like of cable, so pound dollar, euro dollar, pushing to lows. We can see here actually, if we pull up the euro dollar chart, we can actually see it broke below an ascending trend line that was acting as support pretty much since the lows back here in August, which coincides with those highs that we saw in the dollar index. So we've now broken down below it. It's a case of how far this momentum goes once again before finding another kind of foot to stand on and to push higher. But Monty, what are your views on the dollar last week?
Yeah, I know. I think dollar bulls are going to want to try and get everything they can get out of this hawkish twist that they got, not just from Powell, but from the other FOMC members. Like any talk of not full on easing mode or taking the foot off the gas even just a little bit, I think that's something that they're gonna latch onto that, because they've been waiting quite a while for this sort of recovery. And even if you look at clients on our end, they have been generally majority buy, euro USD, pound USD. So essentially they were minority buy, or majority excuse me, they were, how would I say that? They were minority sell when it comes to Euro USD, and they've been in the minority expecting this against this dollar bullishness that we've seen so far. I think, though, the other thing to keep in mind is if you look at the other areas, if the squeeze is on, so to speak, from a tariff point of view, from U.S. demanding investments globally and stuff like that, that could end up harming. I mean, maybe not initially, but eventually that could end up harming, given the worst terms of trade that some of these other areas are going to get. So that might end up harming them. And the other thing you have to keep in mind is whether or not, with the tariffs and so on and so forth. And I know there's the Supreme Court hearing this Wednesday with regards to the tariffs, but whether the legality of it, but when it comes to tariffs and all that, at the end of the day, if that really does harm exports from the Eurozone, from China into the US, or in general just harms a lot of these export oriented industries, that's obviously a negative for a lot of these currencies, and that's obviously going to be something bullish for the US dollar. So we, unfortunately, I wish we didn't have the government shutdown, just so I could see the latest COT reports in terms of where institutions are positioning themselves when it comes to on the FX front, because before they went offline, before we stopped getting these figures out of the CFTC, which was the last figures we got were towards the end of September, and then came the shutdown. But before that, they were majority buy on the euro, heavy buy, I should say. They were, and obviously those figures have changed, because that there's a huge chunk of them that are momentum based. So if they see that the momentum is waning, you'll see a lot of those momentum longs start to get out and take profit. They were very close to the middle when it came to the cable. So they were net sell about 51%, and they were net short on USD/JPY, in other words, net long the yen. Though I think after the latest that we saw, this is because this was prior to Takaishi, so I'm guessing now things would have changed and they would have backed off a little bit, and you might have seen them start to position a little bit more, at least the momentum guys start to position more in favor of the US dollar.
Yeah, it'll be interesting to see how this momentum unfolds. And looking at cable, as I mentioned earlier, we do have the Bank of England meeting this week. Expected to be actually, the momentum has shifted, interestingly or not. We've actually seen markets now pricing in more heavily towards a cut at this meeting. It's not the majority of the expectations. I think markets are currently about 70% priced in for no change, with about 30% priced in for a rate cut. That is a significant change from the start of the month, where markets were heavily skewed towards the no cutting, so no change. Now, the issue with the UK, which has been for a while, and the issue the Bank of England faces, is stagflation. We've seen the UK economy being one of the developed economies that has struggled the most with getting inflation down to target. It's still way above target. If it's still a way away from that 2% area. But we have seen some softening in recent months, and some of the latest data, specifically around the services sector, did show a softening in price pressures, and that is what's led markets to price in a higher chance of a rate cut. As I said, still not the expectations, with around 70% of those expectations pricing in no change, but it has shifted the dynamic as well. So it will place more pressure, more expectation on Governor Bailey's view and outlook of monetary policy over the coming months. When is the central bank going to be able to kind of start and accommodate policy more significantly or more rapidly to the evolving environment as growth slows? as the labor market slows, but inflation still remains above target. So it is a little bit of a tricky situation for the Bank of England. It's definitely much more intertwined when it comes to price pressures than, for example, the United States. So it's now a case of how long can monetary policy stay in the current restrictive territory without it weighing too much on the labor market, on economic growth. And I think that's really where the tough balancing act is for the Bank of England. And if we're looking at cable, for example, you would expect to see the rate differentials to be positive for the pound if the Bank of England keeps rates unchanged, especially at a time when the Federal Reserve cut rates last week. However, there is these concerns about the outlook of the UK economy, which potentially weigh on these expectations of the pound moving forward. And of course, with the Federal Reserve now having essentially to some extent push back on their own rate cutting mandate, then of course it looks like cable could continue to see further downside pressure, even though, as we can see here on the daily chart, we have seen a little bit of an attempt to soften some of that sell-off just around that 130 mark, which is that 131 mark. We've seen a little bit of support coming in for the currency, but nonetheless, not really much expected from the meeting when it comes to the decision. A lot of expectation around what's the future positioning of the central bank, given the latest data that we've seen. Now, other than that, Monty, we also have the RBA. I know it may be a bit out of both of our mandates, but we did have a note from Kyle this morning, just kind of highlighting what to watch out for, just in case anyone on the call is interested on that. And just a reminder for everyone, as always, if you have any questions, please put them through now, because we are going to go into the question section. We already answered a few as we go, but just quickly on the RBA, I believe nothing is expected from them, especially because of inflation. Inflation has remained sticky, especially the inflation figures for September, which actually saw a surprise jump both in headline and underlying prices, pushing above the central bank's target. Headline inflation coming in at 3.2%. And then we also saw the annual trim CPI coming up to 3%, far above those 2.7% estimates that had been. So essentially, this dynamic means that maybe the policy isn't as restricted as expected, and therefore no expectations for the RBA to cut rates either. So definitely watch out for that as well. That will be happening this evening for us in Europe, heading into the Asian session overnight for us. Monty, gold is a big one for this webinar. Everyone loves gold. We always have questions in gold. What are your views on it, given what we saw last week?
Yeah, I mean, when it comes to gold, my goodness, I think when from my point of view, with because I always like to organize things. We have a question about what kind of trading strategy we use. Obviously, we can't give out, we can't give. Well, where's the disclaimer on that one, Danielle? But basically, we can't really, we can't give our opinions or thoughts on that. I'll just say that my style, for example, is that you look at, if you want to organize your thoughts, you look at the key technical indicators. You make it, you label an overview. It doesn't mean that overview is going to hold. And when it comes to gold, for a very long time, the overview was what I like to call bull average, which essentially means that you're either working with a large channel or you basically very, very cautious buying on any dips. You can buy on this, but essentially very, very cautious. That's if you think that this overview is going to continue. And that shifted on the weekly time frame. It's still bullish if you want to zoom out to the weekly, but if you look at the daily time frame, that shifted back when we had the big jump across above 4,000. The overview shifted on my end from bull average to volatile, and that just meant that you're going with breakout strategies, because you know that when things get this crazy, this high, and combined with record highs, combined with the increased uncertainty, and where any small factor, positive or negative, can easily cause this price to change, that means that you know that if you know for a fact that prices aren't going to settle here, then you obviously want to consider net to go for a breakout strategy. That therefore you're going, whether it's on a daily level or weekly level, you're essentially going with the move instead of saying, oh, I'm going to try and trade a certain range if those ranges aren't going to hold. And that's kind of what happened when it came to gold, is that you had these breakouts, it went volatile, it had breakouts, it went high. And then when you had that massive pullback, it was still volatile. So sell breakouts were doing very well. So I think it's been a good few weeks for net for breakout strategies. I'm not saying that that'll remain the case, but that's how it's been for gold. And interesting enough, of course, silver, because the precious metal cousin tends to follow in its footsteps, even if it has outperformed on the way up, whereas underperformed. So the gold silver ratio was going down as silver was doing well on the way up, but then when they all came down, gold kind of recovered a little bit. But essentially, I think silver is also following in the sense that you have a volatile overview on the daily time frame, still a bullish overview on the weekly time frame, but again with caution buying on any key support levels. Usually doing so only after a significant reversal. So letting it go through the level. If it comes back, if it recovers, then you go with it. Otherwise, just let it go. Let the pawns go first on any pullback, and then you sort of go in afterwards if you think that there's some sort of fall through.
Yeah, think one of the key drivers for silver in the last few months, which will likely continue to be a tailwind in the near future, is that kind of undersupply of the precious metal. We know silver is used heavily both in the renewable sector and also in the car sector. Its manufacturing usage is really one of the drivers of the precious metal, but it's come at a time when the supply of silver has been shortening. It's usually mined as a byproduct of other metals, so gold and copper, and there's also been declining investment in the last few decades into the mining sector. So all of that has kind of culminated into a scenario where we have limited supply at a time when demand from the industrial sector has become pretty much very strong, and expectations of growth in that sector. So that has been driving a lot of the momentum in silver, alongside that safe haven demand that it also connects with its bigger cousin, as we say, from gold. So there has been a lot of momentum on the back of that. That doesn't say that it's always going to be a positive trend, even if there is tailwinds from the fundamental sector, as we've seen with both gold and silver. We got to a point where the price had gotten very far ahead of it. If we're looking at the RSI, for example, here, you can see how gold had remained in overbought territory pretty much from the start of September all the way to the end of October, when that pullback happened. So really pushing the limits here. It become a little bit of a frenzy. In fact, there were pictures from people outside of gold shops trying to buy physical bullion, just because of the speculation and the view that the price had been going up and up. So that in itself, when it starts to become so mainstream media and so widespread, it usually talks about a frenzy and about a market that's become very overcrowded. And that is in fact what happened with gold. We saw that pullback, that significant pullback that we saw on Tuesday last week, down over 5% on the day, kind of resetting some of those expectations. The momentum has continued to the downside a little bit. There are some headlines that you could say helped this, whether it's the easing of tensions between China and the US that maybe pulled away some of the need for safe havens, whether it's the Federal Reserve, again, last week, kind of being a little bit more hawkish, therefore, not being so positive for gold as a non-yielding asset. So there are some fundamental stories that kind of support this pullback, but I think it was mostly technical. It was just resetting some very hot pricing that had been happening over the last few weeks that kind of got a little bit overextended and overhyped. And I think essentially, if you're looking at the long-term momentum for gold, I think the fundamentals hasn't changed. You've still got backing from central bank buying, a debasement trade, softer rates, in the near future. All of that continues to back the momentum for gold. However, from the technical side, you do also have to watch out, as Monty was saying, for some of those moves and really test where the market is going before, I think, deciding exactly where you want to be, on which side of the trade you want to be. It is a very volatile environment. Last week was probably one of the most volatile weeks that we've seen in quite a while. So always, of course, watch out when you are trading, that you are aware of, where the market is going, and that it can always kind of go the other way. Monty, we've kind of gone past the half-an-hour mark, which is usually when we start to wrap things up. Is there anything else you want to kind of go over? Anything else you want to say that maybe we haven't covered?
I don't know. I could just talk. Someone was asking about where institutions are positioned. I don't know if we have time. Just quickly, the issue is that, like I mentioned, the CO2 report that I'm getting out of the CFTC, they stopped releasing them because of the government shutdown. But the latest figures that we had, as I mentioned, they were net long euro, net long JPY, which means net sell USD JPY. And when it comes to equity indices, just in case anyone's interested, they were net sell S&P 500. But keep in mind, there's a lot of hedging going on there. So a lot of times they want to hedge their exposure, they'll be short. So it's generally okay for them to be short there, as well as when it comes to the NASDAQ, though they were net long 58%. The Dow, which is where you'll see the biggest momentum play. That's where they really like to track the momentum, or at least that's what I've seen in my experience. They actually shifted from net sell to the middle, if that means anything, and then net short also when it comes to Russell. Whereas when it comes to commodities, yeah, precious metals specifically, yes, net long gold and in extreme buy territory, 83%, net long in silver, 78%, net long in crude oil, 67%. So I hope that, I think that was Kareem who asked that question. I hope that answers your question.
Well, I think that takes us to the very end. Thank you everyone, of course, so much for joining us. This video is recorded. It will be posted on our YouTube channel. So if you need to watch it again or if you need to share it with your friends, feel free to do that. Monty, thank you so much for stepping in for Carl this week. It's been a pleasure having you. And thank you everyone. We'll see you again next week here at the same time. Have a lovely week.
All the best, everyone.